There are hedge fund managers making $1 million an hour. You know, it's crazy, right? It's money everywhere. It's money in everything. I want to help you. Start your business today. Come join my royal family. Subscribe to Casino is the Name. Hey, yo, what's going on right now? You're watching Casino is the Name. And in this video, I wanted to talk to you guys about the different options you have when it comes to getting into real estate, like the different types of loans that you can use in order to get into real estate. A lot of people don't really know how or how to buy real estate or the different options that are available. And I was just recently having a conversation with a friend of mine, and it was kind of interesting because I had recently discovered some different types of loans through Kelley Parker, and which is the real estate guru that I go around Atlanta with. If you haven't seen those videos, I got some videos of me and him where he flips houses throughout Atlanta, and so I was learning some stuff because I started looking into like maybe doing a flip. Now I have a rental property, I run a few things in real estate, but I've never flipped a property, right? And so I was just looking and doing it, just thinking about it, like what's possible. I was definitely thinking about buying another property. I'm just like really in an investment mode right now. And so, I was learning some stuff from him, and I was in conversation with a friend of mine the other day, and he said he's looking to buy something in like 2 years, but he also thought about building and things like that. So somehow me and him just started talking about the different options that he had available. And so quickly I had ran through so many different types of options, or I'm gonna say necessarily so many, but I had so many details on things that he was like, yo, I just need to set up a day where we could just sit down and look at all the options. So I'm not gonna go through every option on this video, but I'm gonna just talk about a few things that you might want to try. Okay, first, and this isn't necessarily about whether or not you want to flip a property. This might be just for you to get your first property, which may be the property you live in. This might be for you to flip a property. This might be for you to acquire a rental unit. You can use this information for whatever you plan on using it for. All right, I'm just going to tell you different ways that you can get started acquiring properties. The number one way, and my favorite way, to get into a property is through a VA loan. Now, I don't know if you're a disabled veteran or if you're any kind of veteran, but if you use your VA loan, you can get into a property with no money down. And in Atlanta, the limit was $510,000. I don't think there is a limit anymore, so long as you make enough money to cover the mortgage and your credit is good or whatever, decent or whatever. The VA loan is no money down. So no money out of pocket. You ain't got to come up with 3.5%. You ain't got to come up with 20%. You ain't got to come up with 30, 40, 50%. You ain't got to do none of that. So long, remember, the house has to be livable. You have to be able to afford the mortgage. And, you have to be able to have a VA loan. And so a VA loan is for veterans. So also there is what they call a VA funding fee. All of these bank loans, they have these fees that they add in, or you got to pay down, or all kind of stuff. So the VA funding fee is rolled. I'm sure it's rolled into the loan, but you don't have to pay. What is it called? What is it called in the FHA loan when you don't pay over 20%? I can't remember the name of it. But if you don't pay over 20% for a FHA loan, you get hit with this. It's some kind of insurance, PMI, mortgage insurance. You get hit with mortgage insurance, and so that mortgage insurance gets added into the mortgage payment. But with a VA loan, you're putting down no money, so you're definitely not putting down 20%. Plus, you don't incur the PMI. You don't have to pay the insurance as well. So That's one of the main ways. Now, also, if you're a disabled veteran of 10% or more, you don't have to pay. You don't even do the VA funding fee. They waive the VA funding fee, which is what happened in my situation. Also, I was able to acquire. So my first house I bought in like 2009, and this house I bought in 2016, 17. I don't even remember. Like 2016, I think. So maybe 2000. I don't know. 2016. So I bought this house in 2016, and I was still able to use the same VA loan that I had originally, because usually people think you use the VA loan and then once you refinance out of that loan and you can and then you you close out that loan, then you can use it again. But no, as long as you don't spend over the benefit amount, you can actually use the loan again. And so I bought my second house on that loan, and so I have two properties through that VA loan. Of course, I bought them years apart, and I had moved and I rented it out, so it didn't go against my income and everything like that. But you can start getting into real estate if you have a VA loan. To me, that is the best option. The problem with that option is you do have to live in that property for up to a year, but you can buy up to a 4-unit with that VA loan, because up to 4-unit is still considered single family. So if you could buy a duplex, rent one side out, live in one side, that'll be great. If you don't mind, sharing that kind of space, but you'll have to be there for a year. Or you can buy up to a 4-unit, live in 1 unit, and rent the other 3 units out. That's a great option if you're fortunate to find something like that. It was not available here in Atlanta. Everything was sold up. And also, another issue with necessarily getting a VA loan is the house has to be already in decent shape. Like, it already has to be move-in capable. You can't get a house that won't pass living inspections. It has to not be a property that is still in repair. So you have to get something that's decent. So that's kind of a problem with the VA loan, because it's really hard for you to go in, find a property that might need a little work, throw some paint on the walls, and raise the value of it. Those houses already need to be decent already. Also, you can't build. Now, I did build this house with the VA loan, but you have to go through a national builder or a builder who is willing to build the house to your specs, because even though they don't have you necessarily locked in under the VA loan, in just hopes that you're gonna, you're actually planning on buying that house. So another type of loan is called a construction loan. Those loans are not necessarily the easiest to get. They're probably pretty difficult. Probably have to put down a pretty good amount of money. But a development type of loan where you're actually going to construct, like you're going to find a piece of land, build on it, that's a construction loan. You can't do those with that's a kind of loan from a VA loan. You can't do those with the VA loan. So you have the construction loan. That's the type of loan that you get. Once you do the construction loan goes then into, say, maybe a FHA. But you have to get the construction loan, build the construction on the property, get the construction done. Then you have to convert that into, say, an FHA loan or something else, or a VA loan if you're going to use a VA loan after that. Those are options. FHA loan, you have to put 3.5% down. Excuse me. And it's very similar to the VA loan in the fact that I believe the house has to be in decent shape that you can move in. I don't believe they allow you to do any work to make the house livable after the fact. It already has to be in decent shape, I believe, before. But you have to put 3.5% down. What does that look like? $100,000, 3.5% is $3,500. $200,000, 3.5% is $7,000. You see what I did there? 3,500 times 2. You see how I did that? Anyway, so that's what that kind of looks like. That is still not including closing costs, and your mortgage may be raised $100 to $150, $200 in PMI, primary mortgage insurance, or something like that. I don't know. I know it's mortgage insurance, PMI, but it gets raised. It gets raised $100, $200, $300, something like that for mortgage insurance on top of the already interest rate, mortgage, principal, and escrow. It's on top of that. So your mortgage can go from $1,200 a month to $1,500 a month, or $1,450 or something like that, just depending on the PMI. And so now if you put 20% down on the FHA loan, then you won't incur PMI, but you have to come out of pocket 20%. So what does 20% look like? 20% looks like out of $100,000, $20,000. And out of $200,000, it looks like $40,000 out of pocket. Or you just decide you're gonna put down $7,000 on a $200,000 loan and incur the $250, $200, whatever it is in the PMI. That's kind of what that looks like. Okay, so we talked about the VA loan, the construction loan, which you might have to put 25% down, 30% down, 40%. I don't know what percent you have to put down with the construction loan, but that's the construction loan. Now, we talked about VA loan, construction loan, FHA loan. Now let's talk about the conventional loan. Conventional loan, the property doesn't have to be in good shape. They usually want 20, 30% down. And whatever that is, you can pretty much get into a house that needs a lot of work with a conventional loan. They don't really care the type of property. Usually interest rates are a bit higher for what I know, and as well as they require a little bit higher of a credit score, I believe. But that would all just depend on the lender, right? But a conventional loan will allow you to buy that property that needs to be fixed up, allow you to get in there, fix it up, and then raise the value of it. But they require a bit more down, 20 to 40% I've seen. So just depends. All right, so there's also one called a 203K loan. I really am interested in the 203K loan, and it's kind of like a bridge between like a FHA loan and a construction, not a construction loan, but it's kind of like a bridge between like a construction loan and a FHA loan. But a 203K loan allows it's two types. You can look these up, but the 203K loan allows you to come in. I don't know if it's 3.5%. They may still allow you to put 3.5% down on the property, and they also finance the construction, I believe. So you can get a property that needs work as basically like your primary residence. Like you're planning on living there, but it needs $30,000 worth of work. But as long as the house is, the after repair value would be, I guess, whatever it is, percentage wise, maybe 75%, 80%. I'm not really sure what the number is. As long as it's inside of that, they'll let you go in as long as you got a licensed contractor to do the work, and then you can refinance into a regular FHA loan or something like that. But it's just like a good way to find a property that needs work, and then get the house, do the work on it, and then refinance into a regular. So you'll get a chance to like customize your place. I really like that one. I'm really looking into something like that. And then lastly that I want to talk about is the hard money loan. So if you do flips, hard money could be great for you, because they don't ask too many questions. I mean, as long as the property makes sense financially and things like that, and you have the money to put down and you can show how much money you have in order to flip the property, then they'll pretty much fund even a brand new build if you got to build from the ground up without having to go through the traditional channels of going through banks and things like that, like regular banks. So hard money lenders, I talked to one. They wanted, because I had never flipped a house before, they wanted me to put 25% down on whatever the property was, and it's a very complicated like number system, right? They wanted to put 25% down on the property. They will fund up to 100% of the remodel costs, but it has to be within 75% of the ARV, or after repair value. So they'll do that, right? But the minimum that you would have to put down was 20,000, and they would loan 7 times whatever that is. So it's like so many things. So 20,000 would open up you to 140,000, but you still have to put at least 25,000 or 25% down, right? So on what does that look like? So on $100,000, 25% is 25,000. On 200,000, 25% is 50,000. So that's how that looks, right? But if you were able to show that you had 25,000, well, let's say you had 20,000, which is the minimum. 20,000 allows you to put down 20% down, 25% down on 80,000, right? So 20,000, put 20% down on 80,000, you get the property. As long as the property, after you put the money into it, is below 75% of the after repair value, then they'll loan you the money so long as the 100% of the remodel. And then you have draws that they do a draw like you put in the sink, then they come out and check the kitchen to make sure you put the sink in, then they cut that. You know, it's a very complex process. That's probably the one reason why I'm a little like, I don't know. It's just a lot of, you got to find a sweet spot type of house. And if it gets, you get with a good real estate agency like Kelley Parker or something, then, you know, he can find these properties that would fit within whatever the budget is that you have. And so yeah, so and then you sell the house at, let's say you get a house for, you fix it up and it's 200,000. But you only spend 150,000 acquiring, fixing up, and everything like that, and you make your spread. You know, it's good money. Anyway, right now you're watching Casino Is the Name, man, and I'm out.
Hey, yo, what's going on? Right now you're watching Casino Is the Name, and if you want to know how I started my trucking business, I have an ebook called Big Shot, Hot Shot, Volume 1, on your trucking authority. The link is going to be in the description. It'll pretty much tell you everything from if the taxes to different types of trailers and all sorts of things. It's a great book, 5-star reviews. Link will be in the description. Go get it. Yeah.
Beat me up, Scotty.
Me and her together, we just count it up. Money on my mind, I can't get enough. Don't play with my money, you don't want no beef. Cause I come from the bottom, I come from the street. When she first saw me, she said, who is that? When a man saw me, he called me a threat. I'm the one that really live with a rap. They ain't never did it, they ain't really trap. You say you want to be successful, but what's stopping you? Can't nothing stop you from being successful except for you. You standing in your own way. I came from the bottom. I ain't know nothing but the grind. You can't tell me nothing about that. I called the bus at Basin Street Projects in Tallahassee, Florida. You hear me? I used to think $1 million would last me my whole life. I'd have made that and spent that. $1 million ain't enough.
There are hedge fund managers making $1 million an hour. You know, it's crazy, right? It's money everywhere. It's money in everything. I want to help you. Start your business today. Come join my royal family. Subscribe to Casino Is the Name.